Right, good afternoon, everyone. Happy St George's Day to you all. My name is Chris Wilkins, Wilkins Southworth. We do the tax of PPP and a lot of the franchise partners. We've got 45 minutes together. It's going to be a whistle-stop tour. There's 3 pieces of really big legislation just come in this month. The piece of legislation came in January, and there's 4 tax cases, and one of which was only decided at the Supreme Court last week to withdraw it. So they're all relevant to what you're doing. I can pretty much guarantee that you'll all get something out of this. Your entrance fee will be refunded if you're not happy. So hopefully you'll all enjoy it. So we're not going to go through everything in as much detail. We've got over 70 pages to go through on slides, and we've got 45 minutes. But let's start. This is what we're going to look at. Abolition of the renewals basis. That kicks in on the 6th of April 2003. VAT 708. That's a really relevant subject at the moment. Sideways loss relief. 2013, sorry, I'm 10 years out. Real-time information. That's important for people who have staff. You may not have staff at the moment, but if you expand, that's something that's coming in. Real-time information will affect you. National Employment Savings Trust. That's to do with pensions for your staff. That is also relevant. High Income Child Benefit Charge came in the 7th of January. That certainly affects people who may not have tax returns at the moment, who will have them. And we've got 4 tax cases here. Because we're coming up to lunch, I've got something on a Dutch sandwich, and we'll explain that later. Added incentive is I've got some pictures of some private properties gone through the keyhole, just to give you a view of how Andrew Borrell and John Rose live. So that'll be something to look forward to later. Right, renewals basis. What happened is that the revenue have always allowed renewals for plant and tools. However, by concessionary basis, before capital allowances were introduced, you allowed renewals basis for things like furnishings in the property, linen, bed linen, items around the house, sofas, things like that. From the 6th of April, that's been withdrawn. Prior to that, you had the ability to have a renewals basis or a 10% wear and tear, so you could have the 2. Now what happens is you're only allowed to claim 10% wear and tear basis for furnished properties. Unfurnished properties, you cannot claim it. So this must affect people who haven't claimed capital allowances on those items. So if your accountant has claimed any capital allowances on these items, you cannot claim the renewals basis or 10% wear and tear basis. So the general rule is, if you bought, say, a washing machine in your property, you didn't claim capital allowances on it, then when you replace that washing machine, then you were allowed to put it in under the renewals basis, so you claim for the cost of that. So the benefit then is for the second item of all of those, for your washing machines, dishwashers, beds, sofas, all the rest of it, you can claim those costs in the profit and loss, which means you get 100% tax relief on that expense. However, the revenue said that was by concession, so they can't do it. What I did is I actually went on Savills' website, and for those of you who didn't get an invite to Andrew Borrell's new housewarming party, that's the reason. So, wear and tear allowance, how does that work? Well, the wear and tear allowance is only available for furnished property, so that means it must be suitable for people to move into and live normally, i.e. it must have sofas, it must have beds, etc. If you've got that, you can claim the 10% deduction. 10% deduction includes things like suites, beds, carpets, curtains, linen, crockery, cutlery. What happens, though, is that it's not the end of the world, the renewals basis. You have something in there that you can claim for revenue repairs on the basic fabric. So what happens is that if you've got items that are normally fixed to the property that you wouldn't take with you when you sell, such as boilers, toilets, wash hand basins, etc., you can still claim when you replace those. So 10% wear and tear allowance doesn't cover those items. So those items are called integral features. And the way you may have come across those before is if you bought a property for, say, £258,000, if you ever look at any tax cases, you may see people say, well, actually, £9,000 of that purchase price is integral features. What does that mean? Well, that means that my property cost me below £250,000, £249,000, which means I save stamp duty. So people say, well, the integral features could be garden sheds, ornaments in the garden, items like that. And if they get that, in this case, to more than £8,000, then their stamp duty reduces considerably. So it's those items that you can still claim to replace. Residential property is let unfurnished, which means that it doesn't have beds, chairs, whatever, which means you can't claim the 10% wear and tear allowance. The reference at the bottom, HM Property Income Manual, is the reference to where that's come from. A lot of this comes from Property Income Manual, which is where the revenue get it from. I'll give you an example of how you make this claim. This is one of my favourite clients, ABC Limited, and what you've got there is a turnover with cost of sales items. Predominantly, cost of sales items are those costs that directly relate to rent, i.e. you'll see that it's got rent here. The rent is the rent that you pay to the owner of the property, which is predominantly yourself, and then this is your limited company. So the limited company has the head lease, and then the rental income is the sublease from the HMO tenants. So in this case, we've got gross profit of £37,000. Then we've got overhead costs. You can see this is a typical Wilkins Southworth client because it hasn't got a profit at the end. So we're okay on that. Now, if we assume that everything's the same for the following year, so if you assume that those repairs are repairs on integral features, then they will be allowed from the 6th of April this year. So what that means is that if you haven't claimed capital allowances on those items, because you can't claim it twice, you can't claim 10% wear and tear and capital allowances, then under extra statutory concession, that's ESC B47, another revenue concession, this is how you calculate your wear and tear allowance. And the way it works is you've got rental income, which is your original rental income. You then deduct the expenses that a tenant would bear if the landlord didn't provide them. So you'll notice that one of the most important things, one of the biggest costs, is the rent that the company pays to you as the owner of the property. That's not in there, because the tenant wouldn't bear that cost otherwise. So by doing this, it's not all lost, because in this scenario, this client would be claiming 10% of £70,687 in their accounts. So that £7,068 would be an expense that they would claim in their accounts in the year ended 31st of August 2013, i.e. the year after the legislation kicks in. So in that case, you can't claim to renew your washing machine, etc., because that was on the renewals basis. This is the new basis, and this is how it's done. This isn't the end of the world. Is it a threat or is it opportunity? I think these sometimes are opportunities. Wear and tear allowance, what happens is that the legislation says that you can claim the wear and tear allowance not just in your own rental accounts, i.e. you rent the property to the company, but that rental figure is a lower figure than the rent that the company receives from the tenants. So if you follow the sequence of events, I'd much rather be claiming 10% of a higher rental figure than in your own personal rental accounts. And you have the choice, because the wear and tear allowance can be claimed by a company or by an individual. And that's the advantage. So what you do is you look for a client's circumstances and find the one that's most appropriate to them to get the biggest tax relief. And in this case, it's better to claim it. Now, why is it also not too bad? Well, it's not too bad because if I've already into my first or second property, I've already bought my washing machines, I've bought my beds, things like that. I'm not going to be replacing those items every year. Even if I replace nothing, I still claim £7,068. Whereas on the renewals basis, you can only claim it if you pay that expense. Now, from now on, we don't have the opportunity. What I'm saying is you may well be better off. It all depends on your rental income and your other expenses. Well, that's not the end of the world. So that's how that one works.